So we are seeing these cracks in the AI stocks, but of course, bull markets often have down periods. Let's get more from Lesley Marks, Chief Investment Officer at Mackenzie Investments. Lesley, thank you very much indeed for joining us. Let's pop up a one-year chart for the NASDAQ 100 as a proxy for the AI stocks. What do you think? Does this feel like a decisive turning away from these big tech names? And they still have soared, obviously, over the past year.
Well, of course. And I mean, it's interesting to see how people have so quickly jumped on this bandwagon of the negative sentiment around AI. Just, a week or two ago, there was nothing, negative one could say, and the prices were just, basically moving straight upward. So I think this is a very healthy pullback or correction for our markets. When you look at the broader market, the S&P, for example, is only down 3.5%. I mean, I know it feels like a lot more because a lot of the stocks that were darlings, to your point, in this AI price run up are off, more than 10%, and some I've been looking at in the 20% range. So kind of feels worse than it really is right now. But I think that's because of the narrowness that we saw in price appreciation for equities.
What about gold? What are you telling clients about gold right now?
So gold has also been part of this same momentum trade, if you will. We've seen gold trade very much like stocks leveraged to the AI trade, leveraged to Bitcoin, for example. Again, I want to highlight the narrowness in the market. There were a few very key themes that have been driving stocks. And so what we're seeing right now is a high correlation between all of these key themes in the sense of a pullback. And so what is the common thread here? I think the common thread here has been retail interest in a lot of these themes. And what we have seen over the last couple of weeks is a decline in retail investors' participation in the themes. And that's really taken the froth out of a lot of these markets. So I think we ultimately will end up in a better place where stocks, commodities start trading on their fundamentals as opposed to this strong momentum push that's really been the dominant factor this year and really part of what's been driving the gold price higher.
You're a great person to talk to about the sentiment among investment advisors and planners. Tell us, have they changed their minds about AI? I guess it's difficult for them, isn't there? I guess they have some clients saying, why aren't you matching the NASDAQ? Why aren't you keeping up with these AI stocks? But that can be a dangerous strategy.
Well, Andy, it sounds like you're certainly living in my head or my life right now. This is a very common question and concern that we get from both advisors and from end clients. They see the big numbers. They see, what their friends are investing in cocktail party chatter. And there does seem to be, or there has seemed to have been a lot of chasing of these big returns, which has really been contributing to the detachment of valuation from fundamentals from a lot of stocks. And use gold as an example as well. So I'll add on that in the commodity space. So we do need to have a bit of a reality check. And I think what the most important thing to focus on is as an investor, or an advisor, what are you trying to achieve in your portfolio, and are you achieving those goals? Not are you maximizing returns, because returns have been very strong for investors, not just in the broader markets, but portfolios in general, even if they've been lagging these key benchmarks. I think most investors have done very well by their own financial plan based on the general strength that we've seen globally across equities. So we want to always come back to what are the goals of the portfolio, and are we meeting those goals? And those are typically not necessarily to have the greatest return that you can possibly achieve.
The Canadian economy, the budget getting shrugs from some because it wasn't decisive. Really, there wasn't much at all about spending cuts. And there is spending on infrastructure, but there wasn't stimulus in terms of actual big corporate tax cuts.
Well, I think that the intention here is really to turn the focus towards capital and infrastructure spending to drive what we commonly would refer to as the multiplier effect in the economy. If we invest in the economy and that helps to offset a shrinking government, then net we will end up in a much stronger place, particularly when it comes to productivity, which has really been a sore spot for Canada and for Canadians. We really haven't achieved the productivity levels that we should. And part of that, or most of that, is due to a lack of investment. So I think the focus on infrastructure is right. What we need to see is this to actually happen. Right now, there's a lot of talk. We want to see the action. We want to see those shovels in the ground. We want to see those projects happening, and then we will benefit from the multiplier effect on our economy.
And the Bank of Canada, does that have a big effect on retail investor sentiment, do you think, when the short-term interest rates come down?
Well, the Bank of Canada is maybe less important when it comes to sentiment, but it is more important when it comes to the average Canadian. The average Canadian's biggest asset tends to be their real estate or their house. And people are buying and selling. And what we are seeing when we have high interest rates, particularly on the short end, is not a lot of activity and a lot of pain in the housing market. So we want to make sure that we have stability in our housing market. That's really important, as I said, for the average Canadian. And so the Bank of Canada's decisions do tend to impact how the housing market behaves. We're starting to see more transactions, but prices are still on a downtrend in housing. And of course, we don't want that to get to a dangerous level where people are, forced to sell their house at prices that put them below water from, where their mortgage is at or, where their cost base is.
Lesley, thank you very much indeed.
Thank you, Andy.
Lesley Marks, Chief Investment Officer at Mackenzie Investments.